Hey everyone, this is the final installment of the option defined section of the syllabus where we go over the concepts of calls and puts. So by now you should know that you can purchase options to buy Apple, a well-known and liquid stock, at a given strike price. You also know that while you can be a holder of options, you can also write options, taking the other side of the option and selling the contracts. But as far as this scenario is concerned, we're just talking only about half of the bigger picture. So far, we've been saying that as the buyer of the contract, you have the option to buy options from the seller at some point in the future. But can you do the opposite? Can you purchase the option with the end goal to sell rather than buy contracts of Apple, so that the shares go from the holder to the writer? That is, can you obligate someone to buy shares from you? Yes, you can. Let's take a look at real estate first to compare. Real estate is fairly one-sided. Most of the time, the option buyer will indeed exercise their right to buy the house. The homeowner thus must sell their house to the buyer. Even if the buyer chose not to exercise the option, maybe because there was a problem with the plumbing they couldn't come to an agreement to get fixed, then this would be the worst case scenario. The homeowner still owns the home and has a little extra cash in their bank for the trouble, and the buyer got out of purchasing a house that did not suit their needs. But that's in real estate. You're not going to see the opposite version of this. There will be no reasonable case where the options buyer is trying to sell their own home. Think about the implications of this. Normally, the options holder is trying to buy someone else's house at a given price. But what does it mean for the options buyer to try and sell their own house? What if I gave you $1,000 for an options contract that said that you were obligated to buy my house from me in 10 days for $100,000? Would you take such a deal? You'd have $1,000 in your pocket upon agreement of the contract, and the potential requirement to spend another $100,000 to buy my house from me. It's not to say that you couldn't turn around and sell the house yourself for another $200,000 after the fact, but in that case, why wouldn't I just sell my own house for that price instead? Very likely, you would never take such a deal. I'd have to pay you far more than $1,000 to make it interesting to you. Such a deal would rarely, if ever, make economic sense, at least in terms of real estate. Stocks offer a far different set of conditions to work with. Both sorts of trades, being able to buy or sell a given number of shares, happens all the time in the stock market, primarily because stocks are far more liquid than houses are. For options in particular, there is value in taking on the risk of being obligated to buy stocks from someone else. You get paid up front, and if you make good choices, there is the possibility that you will not actually end up being forced to buy those stocks. Should you not be forced to buy those stocks, then you made some money by selling the contract to someone else. The option is said to have expired worthless. Why would you choose to write a contract that obligates you to buy a stock rather than sell the stock? Houses are liquid assets and stable investments. Housing prices are generally predictable. But even the most predictable of companies still have enough modicum of uncertainty built into their stock pricing that if you think you know there might be something happening in the world to impact the price of a given stock, you may take the opposing side. So there are two perspectives that you can take if you were the buyer or the seller of an option contract. Either you have the option to buy or sell shares from the writer, or vice versa. You can be obligated to buy or sell shares from the holder. We call contracts to reflect these two different perspectives calls and puts. A contract that is purchased in order to buy shares is given the name of a call. The seller of a call is obligated to deliver those shares to the buyer of the call before or at the expiration of the agreed upon strike price. This is like the typical options contract on a real estate deal. I, as the buyer, give you, the seller, money to create a contract so that I can buy the house from you at a given price in a given period of time. I want to buy the house from you. The opposite side of the story, that is, when someone purchases an option in order to deliver shares to the opposite party, is called a put. The options holder has the choice to deliver shares to the option seller. The writer of the option, in turn, must purchase those shares from the buyer. They have to spend the money it takes to buy the agreed upon number of shares, be it 100, 500, or 1,000 shares. Let's go back to the definition of an options contract that I presented earlier. Options are a form of contract that can be bought and sold, have an associated expiration date, and obligate the seller to deliver some item at an agreed upon price on or before the date of expiration should the buyer request delivery of that item. calls and puts essentially distinguish the obligation to deliver portion of the definition. Without knowing if a contract is a call or put, we can't distinguish what is expected to happen at expiration. In particular, look at it from the seller side. When expiration occurs, what can potentially happen? If there is a reason for the buyer to exercise the option, will the writer end up having to sell shares or buy shares of stock from the option holder? That is the distinction between a call and put, respectively. It can get a little confusing to keep track of everything, but use calls as your foundation for understanding first. Call buyers are allowed to buy shares from call sellers who must sell those shares to the call buyer if assigned. By looking at it from the call perspective, you can see that there's a degree of alignment that creates a mnemonic for the call side. Call buyers buy shares, call sellers sell shares. Whereas things are flipped around for puts. Put buyers sell shares, put sellers buy shares. The perspective of the call is just slightly easy to remember, and from there you can then reverse engineer to remember what puts do. Remember, there are always two sides to any options contract, regardless if the contract is a call or a put contract. On one side, the buyer side, is the option to exercise the contract. The buyer gets to enforce their will upon the seller, but there's a caveat to consider. It never makes sense to exercise an option if the holder isn't going to make a profit, or if at the very least it doesn't fit in with their bigger plan. Most option holders will not exercise their options until the very last possible moment, and this is usually quite obvious based on the various technical elements that make up the options trade and are highly visible in every broker's platform. The other side of the option trade, for the writer, comes the obligation to fulfill the contract and deliver the correct number of shares. The writer doesn't have to do anything. When assignment occurs, the broker will handle exchange within certain parameters. One day the seller of the contract has an options position, the next day they suddenly have a stock position. The seller cannot stop the transaction from happening. Again, as with the buyer side, it's usually quite obvious when the assignment might happen, so rarely comes as a surprise. Though that said, there are some odd exceptions, which highlights the fact that no trading system is perfect and option holders will sometimes pull the trigger to exercise prematurely, leaving the seller forced to fulfill their end of the bargain at an unexpected time. It can sound somewhat ominous, these concepts of obligations and fulfilling contracts, but it's all par for the course in regular trading. It's helpful to remember that everything is automated and there's always a broker in the middle of the exchange. At no point as a regular retail options trader do you go through the rigmarole of having to try to find a buyer-seller and then write up and exchange the contracts. Writing options contract requests has long since been digitized in the modern era, and is one of the reasons that options trading has become so much easier and so much more popular. Being obligated to fulfill a contract has never been more straightforward. Describing an option. Options are typically described in a straightforward manner, as long as you cover all of the essential elements of a contract. Typically, you will see options often described like this. Bought +2, Apple, 17 January 19, 270 put at 335. This tells us everything. This trader bought 2 put contracts in Apple. The strike price was $270 and they bought it for $3.35 per contract, meaning they spent $670 for both contracts. The contract will expire January 17, 2019, so this buyer will, if it makes sense for them, exercise it on or before that date. The point in any options description is that all the elements are clearly covered, whether or not they're bought or sold, the number of contracts, what the underlying is, what the expiration date is, what the strike price is, whether or not it's a call or put, and the price at the time of purchase. Regardless of being a buyer, seller, or if you've exchanged calls or puts, if you exercise your position or assign stocks, your account balance will reflect the changes that correspond to your activity. Keep in mind the flow of money whenever trading. Money changes hand when the buyer and the seller come to an agreement over the contract. As noted above, the exchange happens through a broker's trading platform and the rest of the options trading system that spans the globe. Unlike real estate, there is no need for lawyers or agents to get involved with the signing of contracts and passing of paperwork. To be perfectly clear, when an option is exercised, the seller is obligated to buy or sell the full value of the stocks at the strike price. New options traders often forget that the option pricing is not the same as the price of the underlying stock, which is significantly higher. Recall that an option trader controls a number of shares through the vehicle of the options contract. A trader does not actually own any stocks at all until the option contract is exercised. As an option seller in particular, you are exposed to far more monetary risk than the option pricing might otherwise indicate, assuming you're not looking at other aspects of options trading, such as hedging. If Apple is going for $270 and a put seller is assigned one contract's worth of shares, then that option seller has to have $27,000 in their account to make this happen. I'm going to assume no margin is available, which is a topic for another time. Do not forget that despite the fact that the options trade for small dollar values like 50 cents or $1.25 or even $12, you are controlling thousands more dollars worth of stocks with each options contract. Calls and puts. These are the two fundamental components of options trading. You will always be buying or selling calls or puts or some combination of the two. There are hundreds of ways to combine them, but only a few of those combinations actually make sense. The best, most reliable combinations are usually fairly simple and straightforward to understand. Enough other factors will come into play when learning about options trading that will demonstrate how quickly trading can be made more complicated long before we even look into the various combinations of puts and calls that can be made. So far, in this section on options defined, we've learned a few things about options basics. An option is a contract with an expiration date and a strike price. The expiration date is an essential component of an options contract. Without it, there is no time pressure for the buyer-seller to take action as the underlying stock moves in according to supply and demand. Without an expiration date, a person interested in the underlying might as well buy, or sell if they have shares of it, the stock directly. Before the expiration date, the buyer has the option to buy or sell 100 shares of an underlying equity at an agreed-upon price called the strike price. The 100 shares per contract is also known as the deliverable. If the buyer, also known as the holder, chooses the option to buy shares from someone else, then they have purchased a call. The seller, also known as the writer of the option, is obligated to sell those shares to the buyer. If the buyer chooses the option to sell shares to someone else, they have purchased a put. The seller is obligated to purchase those shares from the buyer. The seller of an option is said to have received a premium. For the sake of this section, we've covered the essential definition of what a financial option is as it applies to stocks. Next time, we will look more into the various components that make up calls and puts, what defines their intrinsic and extrinsic values, and some of the common vernacular around trading. Thanks a lot, and happy trading.